Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. As gold prices continue their record-breaking ascent, Goldman Sachs, a major investment bank in the U.S., has revised its year-end forecast to $3,100 per ounce, citing a combination of economic uncertainty, central bank demand, and geopolitical risks. The surge has sparked intense debate over the forces driving the market and the broader implications for investors. While some see gold as the ultimate hedge against inflation and economic turmoil, others question whether digital assets can still rival its status as a safe haven investment. Today, we weigh in on the key factors shaping the market and the potential wild cards that could define the next phase of gold rally. And for this, we connect to Song Soo-young, professor of business and economics at Chungang University. Welcome, Professor Song.
Thank you for inviting me, and good evening to you.
Good evening. And also joining us from Texas is Hwa-gyun Kim, professor of banking and finance at Texas A&M University's Mays Business School. Great to have you with us.
Pleasure to join.
So let's start with Professor Kim. So like I've mentioned in our intro, Goldman Sachs has raised its year-end gold price forecast to $3,100 per ounce. What kind of factors do you believe are driving this upward revision?
So as with other assets, gold also has both fundamental demands and also somewhat speculative demands. And the Goldman Sachs main point is about like the tendency of the central banks to buy more gold, and they just keep revising their monthly demand. They already revised upward last year, and then they also do it actually again. So clearly that obviously increased institutional demand for gold. And that type of institutional demand increase clearly pushed the price much higher. And also, typically, the gold price is in line with the interest rate in the opposite way, in that, similar to cash, if the interest rate is lower, then the holding cost, opportunity cost is getting lower. Therefore, gold price tends to go up. And after 2021 or two, it was kind of somewhat revised in that because the other emerging markets, central banks started purchasing gold more, including also other major central banks. That starts increasing the price, and therefore the relation started the breaking up, and then it continues to maintain the trend. That increased the price even further around like 2023, 4, and even now. And then plus, obviously, the new U.S., the Trump administration's, the tariffs and the geopolitical risk and uncertainties obviously heightened the safety demand for gold, and that also increased the price. So if you look at like, the price charts of the gold, currently it's about $29.50. So it's about the maintaining the trend that has been going up since 2021 or so. So if you actually connect the dots like this, then you can see that around the end of 2025, you can see that it's around like $3,100 or even more.
Right. So with all of these factors that are contributing to this rising trend, Professor Song, so could you elaborate for us further on whether the U.S. or other major economies adjusting interest rates, trade policies, or gold reserves, how do you expect them to have the market react?
Yeah, the Professor Kim has described it as overall views and prospects about the relationship between the cash, such as one of the safest currency is U.S. dollar, of course, then, and the relationship, inverse relationship in gold reserves or gold value. But recently, since 2020 or something, the relationship has been looks over. But so during the past several years, that U.S. dollar value has been increased a lot in relation to the U.S. dollar index, such as a basket of the other international currencies. And also, as a result, the relationship between the interest rate and also trade policies and the gold reserves, that has been disrupted very much because of the Trump slapping on the tariff. So that is like the prospect of trade wars and the punitive tariffs clearly plays a role for the the international, the central banks look for the gold reserves, and they would like to adjust the portfolio of the US dollar currency and the gold reserve, and because to be prepared for the upcoming uncertainties of the geopolitical issues. Clearly, so right now, I have noticed that recently we have seen some kind of slight surge of the value of Japanese yen. So as the anchor has mentioned, some digital assets role, I think digital assets role would be minimized because of the geopolitical issue has been played a really big role in the turmoil of some international financial flow and some trade policy. So to that regard, we are very big uncertainties are in front of us. However, and it could be how it will be played out is a really important issue. But today, February 2021 G20 meeting, which will be held in South Africa, then the U.S. Secretary of State will not attend that meeting. So this tells us that some kind of potential detachment between the U.S. economy and other international economy could be intensified, but we have to wait and see what will be played out in the future.
Right, but let's circle back again to what you've mentioned about Trump's trade policies. The Financial Times described gold as the ultimate Trump trade asset, as the price hike is also attributed to his policies. Professor, could you explain for us the relationship between trade wars and gold demand?
Yeah, gold demand, as I look back, the gold price has been increased a lot because when the U.S. economy is very in serious trouble in 2008 and 2010, actually, the gold price has been increased a lot, not just in the U.S., but in Korea and all worldwide. And then, since then, actually, the gold price has been increased. At that time, in 2010, almost the gold price has been almost 400% increase in 1998 or something, early 2000. But however, recently, we have, for the past 10 years, gold price has been increased about 300 times almost. So the value of gold has been clearly increased, but also the U.S. dollar, when the economy is in recovery, it has been strengthened also. So to that regard, the Trump's tariff policy, it is, as I mentioned earlier, it is punitive. And also, it does not help much. What recently in the most serious threat against not only just some kind of adjustments of the value and some hedging method, but what matters to U.S. economy is the low growth rate threat could be real. So some investment analyst has mentioned the possibility has become real. The stagflation will appear with the inflation has been stalled right now because of the tariff. As long as the tariff has been conveyed to the consumer price, the price will go up. And with the hike, therefore, the interest rate also goes up. And then the economic growth rate will be stalled. That is a really, really serious threat. But it is not yet realized, but the possibility has been increased a lot. That's why recently the Trump trade asset that has pushed the gold price very much, and the Japanese yen also.
Right. So with Trump slapping these tariffs to many countries across the world, we had been expecting the U.S. dollar to kind of hike, but it showed signs of weakening despite expectations of strength amid this trade wars. Professor Kim, how could this be explained?
Well, I mean, there are a couple of things, but then, I mean, when the tariffs are given, it's like tax, right? So to other countries. And usually this also raises concerns about like price, because it can push up the price, as Professor Song mentioned. At the same time, if the trade war is really happening in a serious way, then economic activities is going to go down. So these two things can affect obviously the monetary policy of the US and other countries. So if it is more onto cost push reasons of the inflation increases, then clearly the Fed is likely to increase the interest rate back. And that's going to make the dollar stronger in some sense, right? On the other hand, if the trade war leads to more economic disruptions and uncertainties, therefore, we want the worries about, we actually have worries about the economic activities. In that case, the Fed is trying to counteract by lowering the interest rate. I think at this stage, the investors and market participants bet on the latter side, meaning that economic disruption worries or concerns are bigger. Therefore, we expect, or the market participants expect, the interest rate is going to get lower, and that actually expectation is increased. The basically concerns about the U.S. dollar, therefore weakening the dollar. Another big concern is, I think, the fiscal deficits. Clearly, this type of the things about like the tariffs and also the domestic tax cuts, etc., is going to make the fiscal deficit even larger in case of the U.S., unlike what the Trump is arguing. In that case, there's a chance that the U.S. dollar is going to weakening because of the fiscal deficits to GDP always predicts the lower the weaker the dollar basically.
Mm-hmm. So in the wake of this, reports have been suggesting central banks are buying more gold than expected, like you've mentioned. Professor Kim, what are the implications of this central banks buying more gold trend for the global economy?
So central banks purchase these type of assets, including the U.S. treasuries or other safe assets as reserves, because they want to diversify their reserve compositions. And yes, central banks do hold gold, but in good times, in normal times, they don't want to hold too much gold because clearly it also has other, the cost like inventory cost, and also there are several other issues in terms of like speculation and stuff like that. So clearly, if this is indeed the case that the central banks are just purchasing gold and more, then means I think they worry about the economy. So clearly, central bank is, in a sense, either they want or not, is signaling the other market participants, the economy, that there will be a larger increases in uncertainty. At the same time, of course, the central banks want to diversify their assets like reserves. In that case, they probably have to reduce other parts, which is probably dollars. So there's going to be a tendency of a little bit of the dollarization, I think, for this kind of cases. And therefore, most of the uncertainty concerns and also the diversification probably are the biggest implications of this trend.
Right, so we are seeing many people buying on gold with even central banks around the world. But the price of gold on the KRX market specifically is currently trading at almost a 16% premium over international gold prices. Professor Song, what are the key factors contributing to this discrepancy in prices?
Yeah, my answer to your question is actually this is a very temporary, but actually it is called as a kimchi premium, but actually kimchi premium is a mirror image of the Korea discount, I think. And also, when I look back, when I look at the gold price performance in Korean market and in comparison with the U.S. market, as actually today the U.S. dollar value, in terms of U.S. dollar value, there is 1.04% increase relative to the Korean market. The Korean won, it is only just a 0.8%. But however, when you look back for the past 20 years or 10 years and 5 years, so almost the US dollar gold price increase is 583, but whereas in Korean has reached more than 867 percentage points. So this clearly reflects the depreciation of Korean won against the US dollars. But however, Korean economy has expanded a lot. And also, even though the Korean won's value has been depreciated against $1 over the past several decades. However, Korean GDP has grown very a lot. As a result, the rate of return for gold, it has reflected the effect of the Korean won depreciation, and also there is some Korea discount played a role, I think, and then that is why the gold price when it was expressed in Korean won, it has shown a little bit higher premium, but still it reflects the change of the risk of the Korean won and the Korean economy's the discount. So I don't think it is much of an issue, and I believe some investors would like to this kind of arbitrage opportunity to make a purchase in US dollars in the US market and sell it in the Korean market, but it is not readily available. So this kind of trend will persist, I believe.
So it's temporary, but it will persist for the meantime. So we are aware that there's a high premium for Korean prices, but investors are still willing to pay significantly more for gold compared to international markets. What's in it for investors, Professor Song?
Actually, the primary customer clients of the purchase of gold at the individual level, as Professor Kim has mentioned earlier, that the fundamental value of gold and the speculative value of gold. But in Korea, I think the individual cannot trade gold just for the purpose of the speculation. So only when they need some kind of gold. But the fundamental value, I wonder what is the true fundamental value of gold. It is just as a hedging method against some currency value. But from the individual consumer's perspective or individual's perspective, that does not play a much role at all. So I think these, even though domestic investors, I wonder whether there is some institutional investors who would like to adjust the portfolio to hedge the risk of their reserves value depreciation. But so central bank is one of the most biggest customer as an institutional investor. Other speculative investor, institutional investor would like to deal with, trade with these gold, but as an individual market, individual level, the Korean gold price does not have some economic meaning at all.
Right. Now, we've seen the prices of digital currencies rise in the past few years, but gold seemed to have outperformed them. Professor Kim, why do you think gold remains such a strong safe haven asset? It's considered as that despite the rise of digital alternatives.
Well, first of all, it's a physical asset, and you can use it as some precious metal. I'm sure that you have some gold jewelry, rings, and the necklaces and things like that. So we have like a very strong support value. In worst case scenario, at least you can use it for certain uses. So, and it has a long history as a store of value. So unlike digital assets or even equities, the scarcity and the intrinsic worth, actually, there is some positive value. And then I think, because of this, the transaction, the demand always is there. So in worst case scenario, if you bring gold to someone, probably that the other counterparty is going to accept the gold as a medium of exchange. I think that type of belief creates the fundamental value. Of course, it's not huge, but when times are bad, this kind of the fundamental value is going to increase, and that can spur the speculative demand also increase even further. I think so. That's probably the main difference. So I think the basic underlying the low support value, I think of the gold is much higher than the assets like the digital assets like Bitcoin or Ethereum, basically.
Right, so having this physical asset that we could actually see and transact could definitely definitely build trust among investors and transactions. But we will have to conclude our discussion right here. We had more questions, but we're running out of time. Thank you so much for your insights, Professor Song and Professor Kim. We appreciate it so much.
Thank you.
Thank you very much.
And that'll be all from us on Within the Frame. Be sure to tune in next time as we continue to explore the stories that matter. Until then, stay informed and engaged.